Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Larry McDonald. He is the founder of the Bear Traps Report. Larry, thanks for joining us.
Hey, thanks, Ivan. Great to be here.
Yeah, it's a huge pleasure having you on. Larry, you said in a recent interview that we're seeing some of the most disturbing economic trends since COVID. What's disturbing you right now?
Well, our first book, it's in 12 languages now. It's according to the CFA Institute, it's one of the best-selling books of all time in the financial space. It's a New York Times bestseller. It's been translated into 12 languages, and it was about kind of the Lehman crisis, and it was residential real estate that really impacted the big banks back then. Today, it's commercial real estate across the United States that's really mismarked in a lot of places. But the tricky part is it's very similar to the United States in 2007, 8, 6, 7, 8. You had a lot of these adjustable rate mortgages.
Hmm.
And the amount of mortgages that are in the United States in the commercial real estate side that are interest only, that are going to reset in the next 12 months, it's like literally 80% versus 5 years ago is more like less than 50%. So the marketplace, it's just like anything in life. When central banks suppress the cost of capital for longer and longer and longer periods of time, each year, each day, month, minute, they do that. They incentivize uh, risk taking, risk reaching. And so, in the commercial real estate side and on the duration side in the banks, like banks, your average smaller bank, especially the Silicon Valleys of the world, or
Right.
they reached out for yield. And it's similar in commercial real estate where they did transactions at very low interest rates, and those interest rates when those transactions reset over the next 12 months, the losses are going to be spectacular, and it's going to create another type of banking, I guess, another banking panic where we lose another 5 or 10 banks.
And that's been the huge talk lately, Larry, is have we made it through the worst of this banking crisis, or does common sense actually kick in and say no? Is there going to be any sharp dive, let's down in like equities? Even I know you're talking about commercial real estate, but what about equities or the stock market? How will that banking contagion spread across other markets?
Well, I rarely do this, but in February I made a call for a crash on Fox with Maria, and I
Yeah.
haven't done that in a long time. And the reason was because of the regional banks, and now we're seeing some of this spread to insurance companies. And today, like, think about the last like 3 months, you've got 40 retailers that are down 30 to 70%. This is in the retail space. You have big banks like Bank of America 35 to 40% off.
Right.
You've got triple C's in high yield. They're your canary in the coal mine. They lead on the way out. Like, if you look at coming out of Lehman, coming out of COVID, triple C's were tightening, in other words, coming down in yield, bond prices going up. Now triple C's are actually widening. So bond prices down, yields up. And so all the classic indicators, from transports to the banks to the retailers to high yield, they're all telling you that equities are going to come down hard here in the next, could be a month, could be 2 months, but it's probably sometime in the next, I would say 90 days. I was right about the crash in
Right.
the banking system, but the index is being held up by a few names.
And what's the next step? Like, let's say another bank goes and it's a big US bank, hypothetically. What happens to the Fed? Do the Fed finally step in and say, okay, we need to pause, lower rates? And what happens to silver and gold? Like, we're Wall Street Silver. So a lot of people think that precious metals, the second they pause or lower rates, gold is going to skyrocket. Are you in that same camp? What do you think will happen with the Fed decision
Yes, I
there?
mean, they're trying to fight inflation. Government spending in the first 4 months of the year was up 13% year over year. You're We're running nearly I want to say 1.8 trillion dollar, close to a $2 trillion deficit this year. Maybe it's a
Hmm.
little bit less, but you don't kill inflation that way. And so what's happening is that government spending has created uh, sticky inflation,
Right.
and that sticky inflation is now incentivizing the Fed to maybe do another hike or two. That's hurting, it's suppressing gold and silver a little bit, because where gold and silver, as you said, really scream, and you go back 20, 30 years when the Fed stops and then goes toward a tightening, I'm sorry, toward an easing cycle,
Right.
that's where you're going to get the huge move. But this week, Brazil, look at the real, made a big technical breakout this week. Banks in Brazil in June are up close to 10%. And
Wow.
so Brazil is a, some of the EM spots are pretty good leading indicators. And I think at the end of the day, smart money knows that the Fed really can't do much because every bit they push up the front end, so T-bill rates, it just drains the banks of even more capital. That's less capital they have against commercial real estate losses. And it's just like they're just table max. They can't, it's all BS. Like they just
Wow.
they're if they push up rates anymore, they push us really close to a Lehman type situation.
And a lot of people on the internet, they've been talking about credit default swaps on some of these banks that are just out, like, just crazy compared to equities. What are you seeing there with credit default swaps? Is anything scaring you with some of these banks that are you seeing anything there?
Well, US Bank Corp is the fifth largest bank in the United States.
Right.
And this, like you said, I mean, it's crazy. They get the stock market ripping. Some parts of high yield have been okay. Like I said, triple C's are bad.
Hmm.
But when equities rally a lot, you should see the credit default swaps on US Bank Corp and some of these other banks come down sharply. And they're just hanging out higher and higher. And I think it's because the smart money looking around the banks and say, okay, who's got the most exposure to San Francisco? Who's got the most
Right.
exposure to Chicago? Some of the banks are okay. Like I really like Texas Capital Bank, because the Texas banks, they have much less of a commercial real estate problem than some of the California banks.
Mm.
But these are banks that some are small, some are large. They're not as big as Lehman, but the whole group of them together, in terms of if we lose another two or three, it causes such a contraction in lending that leaks over to the consumer. You're starting to see that in all kinds of different spending. ISM data this week in terms of employment was, you've had some of the lowest readings in ISM data on the employment side since recession. So you're just seeing that this is kind of a slow moving
Right.
recession, and there's a lot of leading indicators that are telling you that we're probably in a recession now.
I totally agree with that. With all the uncertainty in the markets and all the chaos, like people don't know what to do. Where are you finding safety right now, or even taking risks, Larry?
Well, on the long side, I mean, we really like I said, EM. Some of these value names have really, like, if you look at growth versus value.
Right.
Uh, so think of growth versus value. So your growth mutual funds or your growth ETFs versus your value ETFs. You had the last 3 years, you had Evergrande, that property crisis, you had the Delta variant, you had all these different COVID variants. And each time you had a move up in growth versus value. Now, you've had this again with the banking crisis. You've had this big move in growth versus value. And so there's almost $17 trillion in the NASDAQ 100, the
Wow.
NDX, almost 17 trillion. And that tells you there's a lot of people crowded and thinking that inflation normalizes at 1 or 2%, right?
Hmm.
And because that's what's happened ever since Lehman. Inflation always normalized 1, 2. Deflation is very good for growth stocks. It's not so good for value. This time around, it's very clear to us that the Fed runs into a problem, they're already starting to ease a little bit and soften the path with elevated inflation. That creates a dynamic that's going to be really good for value stocks. So David Einhorn's Greenlight Capital, Buffett's Berkshire Hathaway, even though Buffett owns a lot of Apple, and he may be reducing his Apple now.
Oh
But
yeah,
value,
probably.
your value equities, your natural gas names, your Southwestern Energy, your Energy Transfer, your AR. These companies are trading at 2 times, 3 times EBITDA. In the case of AR, which is Antero,
Hmm.
they're buying back $2 billion worth of stock, and the market cap of the equity is $6 billion. So these companies have delevered. We love the silver names. We love Hecla. Hecla's got a good balance sheet. The CEO is a page one holder, so he's buying the stock. He's got his skin in the game. And Hecla is your marquee U.S. property in the metal space. And remember, we talked about this last time. Miners that have assets in safe places are going to get a premium for those assets. And so, in the case of, and also in case of natural gas and oil.
Right.
So, because we're gone to more of a multipolar world with more controversy and more political unrest around the world, there's a lot of political unrest facing some of these copper miners. But in places where, like, a lot of Hecla has a decent amount of properties in safe places. Same thing with the reserves of Southwestern Energy and Antero. A lot of these energy companies in the United States that have safer U.S. assets than some global assets, I think there's going to be a premium for those assets.
Yeah, of course. Well, it's I think I'm in the same boat. If you start seeing other countries start to nationalize their mines and it starts getting unsafe other places, it's for sure going to be a premium for all the ones in Canada and the US. But moving on to a little bit of a different topic. A few months ago, Larry, they changed the White House kind of tried to change the definition of a recession. And just last week, last week I just seen an article from the media outlets, and they're coining in the new term. It's full-time employment recession. How bad is the economy if you have to keep changing the definition of a recession?
It's two economies. It's the companies that face, like LVMH, obviously Tiffany's in there,
Hmm.
all these, Ferrari. I can name probably 30 companies that are near all-time highs that face, even Lululemon, the stocks bounce back a lot.
Hmm.
Companies that face wealthy people are doing great. But on the downside, like Macy's, Kohl's, Lowe's, you just have so many retailers that are in pain. And the old pawn shop indicator, I mean, you've got some of these pawn shop equities at all-time highs.
Wow.
We ran a chart with the pawn shops versus retail, and it's like massive. They call it the alligator jaws. And so when you see stuff like that, when you see pawn shops making new highs with Ferrari, with your LVMHs, it just speaks to, there's a lot of wealthy people that now are getting a big pay raise. And so let's just say you had $1 million in the bank, right? And you put it in T-bills, you're getting 50 grand a year on that.
That's
And
pretty good.
two year and a half ago, you were getting 7 grand.
Oh
And
yeah, yeah.
so
That's 50 grand is
so
way better.
yeah, and so that guy or gal in Florida with $1 million in T-bills has a little bit more discretionary spending. But if you're a middle class family,
Right.
you're obviously paying for one or two kids in college. Everything at the grocery store's gone up. That's where the pain is, and it's
Right.
tremendous pain under the surface. So we actually are in a deep kind of, I think we're in a pretty nasty recession for half the, well, I guess more than half of the population. I'd say the bottom 70% is in a pretty bad spot, whereas the top 30%, living off of, a lot of extra interest, and a lot of that
Right.
COVID stimulus is still hanging around, what they call excess savings.
Yeah, you know what? I think you absolutely nailed it. And hopefully as the market develops in the next 2, 3 months, Larry, we can have you back on. And I'm pretty sure you've nailed it like the last time you called it. So hopefully we can have you back on in the next 2, 3 months.
Thanks, Simon.
Yeah,
Always good to catch up.
talk to you soon.